Well, hello and welcome everyone to Right Capital's Friday educational webinar. And my name is Daniel Gregoire. I am the training manager here at Right Capital. And we're really thrilled to be here with all of you. We're about a minute to the top of the hour here, so we'll be getting started shortly. Just wanted to, just welcome you all and let you know that this is, as always, is designed to be an interactive presentation. So we'd love to hear from you if you have any questions as I make my way through the content today. We'll certainly take some time to answer them at the end, and I'll do my best to maybe throw in a few during the actual presentation as well if there are any things that we can make sure kind of work into the presentation. We're going to try to keep this to around 35 minutes of content, just to make sure we're respectful of everyone's time. The Q&A session will of course last as long as it takes to get through the questions, which some days we all know might last for till the top of the hour. But overall, we are here to help. So it looks like we are now at the top of the hour here. Welcome everyone to this presentation on tips and tricks for modeling investment strategies. And what we're going to do today is really provide you a really great overview of RightCapital software as it relates to not only the default investments, assumptions that you're going to see, but we're going to talk through a lot of great information around looking at modeling, let's say, different strategies for the current plan or the proposed plan, for example. And we're also going to talk about a lot of the settings and assumptions that are going to be impacting these types of conversations, and ultimately how you can just best reflect a financial plan that mirrors your clients' current strategies in life. So that's our goal. Again, we're here to help. If there are questions that you have during the webinar today, feel free to use the GoToWebinar control panel. I'll be monitoring that as we go. There's a questions drop-down menu where we can of course see a lot of great information that's asked, and I can then of course make sure to address that. And beyond the webinar today, just as a reminder, you're never alone. You always have us here at Right Capital to help you out, to make sure you can confidently present the financial plans that you build. So whether it's myself today, whether you're new to Right Capital and you're working with a devoted onboarding specialist, or whether you're working with the support team, we all want to make sure you have the tools you need to be successful. So use us. Don't hesitate to ask questions today or to the support team. And with that being said, I think it's about time to start having some fun and in Right Capital and talk a little bit about tips and tricks for modeling investment strategies. Now, I'm going to just quickly pause the screen share as I transition over to Right Capital software, where we can then start diving into all of these nuances of the conversations we'll be having today. So just quickly here, I'm gonna reshare my screen. Hopefully you all can see here my advisor portal landing page within Right Capital software. So this is of course where we're gonna start today, because there are a few areas that I wanna make sure you're all familiar with. And of course, when we talk about modeling different investment strategies, a lot of these conversations we have are going to be dependent on the type of clients you work with. Do you work with younger clients who are going to have investment strategies that are going to change a lot over time, or do you work with mostly retirees who are maybe not seeing as much adjustments, but maybe just want to talk more about distribution sequences? But we're here today to kind of bring the full conversation to you, to talk about what are your options within Right Capital, what maybe are you seeing as a default for different investment strategies, and what are the assumptions that will actually interact with the investments that are really important for you to know about. So the first thing I always like to point out within Right Capital is that there are some default settings that you want to be aware of. When you first create a client plan, unless you've made adjustments already, in many cases, the client's investment strategy is set to stay the same for the client's lifetime. And we can of course adjust that on an individual level. But I just want to make sure that if, again, you work with a certain segment of clients that maybe are expecting a certain type of transition over time, we want to be able to make sure that at an advisor level, you are seeing the ability to actually leverage the global settings that are going to impact your specific client plans that you create. So again, at the advisor level, you can find the gear icon account tab within the advisor portal. You can also see this client presets area. And the reason I bring this area up is because you might notice here that there's an asset allocation method that's going to be an important setting that we'll talk a lot about today. And this asset allocation method, once it's adjusted here at the advisor level in the gear icon account client presets area, will automatically transfer to all of the new clients you create moving forward. So just as an FYI here, everyone, the asset allocation method defaults to using the same investment strategy for all years. So if you have a client who's currently, let's say a younger client in their 40s, they're pretty aggressive in their investments, RightCapital will default to showing that client invested in the same investment strategy when they're, let's say, 90 as they are when they're 40. And we want to make sure that, if you have general recommendations that you provide to the clients, let's say you like to make sure they're in a balanced or a moderate portfolio in retirement and beyond, that's where, again, you can very easily at the advisor level, gear icon, account, client presets area, say that maybe you like to use a pre and post retirement asset allocation where the client in pre-retirement is invested as they are currently within the net worth, aka the data entry, where we're building out their investments. But maybe as we switch to retirement in the financial plan, we might want to see them specifically in a model portfolio that's balanced or moderate. And so again, this would transfer then to all new clients I create. All I have to do is hit save here on the bottom right once that's adjusted. And then if I were to begin entering new clients, I can just click add new client, build them in, and I would see that, again, we'd have an automatic transition to a balanced portfolio at retirement. We're going to talk through where you can see all that and how all that looks. I just want to, again, make sure everyone's comfortable with that global setting, because of course it's going to directly impact every new plan you create, and it might save you a lot of time moving forward to not have to adjust it on the individual client level. So again, last time, the gear icon, account tab, client presets is where you can access that asset allocation method by changing the same investment strategy for all years to using a pre or post retirement investment strategy, or turning on what's called a glide path, which acts very similar to a target date fund and slowly transitions the investments over time. We'll talk a little bit more about the glide path within a client plan where it can be a little more easily explained. Now, what I also want to bring up today, everyone, are the global capital market assumptions that we use as a default here in RightCapital. And those can all be found within the advisor portal when you log in under the assumptions tab. Now, these assumptions tabs will control, of course, the investment returns by asset class. Now, you might see, here that we have large growth under my login, equaling a 10.5% rate of return. And I just want to remind all of you that RightCapital, as a default, is going to use historical averages. 50 years for US equities, 20 years for bonds, for example, to determine what are the rates of return that we're going to associate with each asset class. And as you enter investments into the net worth for the client, we use Morningstar to allocate those investments into one of these broad asset classes. And that is, in fact, how we're going to be entering them into the Monte Carlo analysis to be projected into the future. So if I put, let's say, a GE stock, we'll use Morningstar, we'll allocate that to, US equity, large growth, and that would then earn, a 10.5% rate of return based on my individual assumptions. Now, these assumptions are not changed for you at any time. Once you purchase RightCapital, the assumptions that comes with the system are going to stay that way until you adjust them on your own. The reason being is that making adjustments, for example, if I put 10% here for a 12% rate of return, that is actually going to impact every financial plan I have in my client list. And we don't ever want to put you in a position where you're logging in and you're seeing a probability of success or a financial plan that's different from when you left it last. So we will email you every year when we update these assumptions. You are then welcome to visit this assumptions tab and use the new historical averages if you'd like to enter breakdowns of interest for bonds, obviously, dividends, and capital gains, which all culminate into the total return column. So interest plus dividend plus cap gain equals total return. So that is, of course, how we are set up just as a default. When you come on board with us, you're usually working with an onboarding specialist to align these with your unique advising philosophy. In the Help Center, just as a reference, we do include the actual, current asset return assumptions that we use. So, for example, I'm actually a little outdated. The new historicals are actually showing, around a 11.6% rate of return for large growth, and I had just over 10. But we provide you the indexes that we use to generate those historical values. We also provide you forward-looking assumptions if you like. For example, JP Morgan report that's referenced here for forward-looking assumptions. And again, you're welcome to adjust those as needed, both at the advisor level or at the individual client level. So with that being said, we want to then talk about client plans. How are we mapping out investment strategies, and how is that going to be impacting the actual overall, scenarios that we're building out? So the first thing I'm going to do here, everyone, is pull up one of our case studies for today. Let's look at, Tommy Callahan. So maybe, Tommy and Beverly, maybe they had an auto parts store, let's just say, that they and they're living their life and they're enjoying working with their financial advisor. So I just want to bring this up here quickly that, as we look at entering data into a financial plan at RightCapital, the investment strategy starts with the net worth information. So we look at the investments as of today that are listed in the net worth that'll basically help us to project this information into the future. And so I do want to make sure, we're all aware of just how we're generating this information. So we have two methods. So for example, let's say we have a 401k account that has $11 million in it. Let's say that this 401k, again, is based on an investment asset allocation strategy that's we can see is a moderate investment strategy. So this is based on a 60-40 breakdown of equity and fixed income. We can customize that, model portfolio with risk-alized imported portfolios if we'd like, or even just custom model portfolios we've made that can reflect a specific rate of return, for example. But in this case, the current strategy for this client is to have this retirement account essentially growing with an allocation that's based on a moderate investment strategy. We can see the actual rate of return associated with that moderate investment strategy by analyzing this account in the investments tab. So in the actual investments tab of the financial plan, we can see things like each account broken down, and I can see, again, rates of return associated. Now, this specific plan, you might notice, I've actually adjusted the rates of return to reflect the JP Morgan's forward-looking assumptions. And I've done that purposely here so we can kind of see the contrast, right? So we have historical options, we have forward-looking options, and they can be tailored either at the advisor level or the client level. So for all of my clients, I use historical assumptions, but Tommy and Beverly maybe are really more comfortable using forward-looking assumptions from the JP Morgan report. And I've been able to then say, that because of that, this moderate investment strategy is reflecting a 4% rate of return. And I've adjusted that on an individual level by visiting the settings of this specific client. So in the gear icon settings area for this individual client, I have the ability to say, I want to change the return assumptions specifically here, based on this individual client, instead of using the global assumptions that are laid out here. So I just, again, want to clarify on a few quick, questions here. One of which is, a 2% dividend expectation on small and mid cap? The answer is yes. We do build those in. I do have some additional customized asset classes as well, which are available in the Platinum subscription. But basically, the reason that we break this out the way we do it is more for tax purposes than anything else. We are looking to also identify what percentage of dividends are assumed tax qualified within the financial plan, and understanding this at the individual asset class level helps us with the tax projections. They all just kind of add right up to the total rate of return there. But again, Brad, these are fully customizable, as needed. So just keep that in mind. Great. So again, I was able to set a global assumption for my financial plans, but I was also able to say for Tommy and Beverly specifically, I'd rather use forward-looking rather than historical assumptions for this client. So again, here in the profile net worth, we saw that this retirement account was earning a specific rate of return, but we also can see that there's other ways to tie the investment strategies to an account. Right? Instead of just applying a model portfolio that has, a specific, value to it, we can also determine investment strategies based on holdings and asset classes. So what we see here in this other account, general investing, is that we've actually had the ability to add in individual holdings. Again, any ticker symbols we want to enter here are going to be available. And this is something that we can enter in. We can see the quantity of shares, the price as of last night's close, and as we enter again a certain amount of shares, a cost basis, and hit save, that value will be allocated through Morningstar to essentially impact the investment strategy of this account. So here, for an example, this general investing account is now going to be adjusted in terms of the rate of return based on this new holding that I've entered. I also just want to mention that the actual accounts that are integrated within RightCapital from your advisor level connections, those are also going to have the ability to actually adjust the investment strategy. So you can either choose to base the investment strategy for those accounts that are linked on the holdings, or you can actually choose to change it and say, even though I have the holdings here to determine the value, I'd instead like to drop in a specific model portfolio that's maybe connected through Riskalyze, or maybe was built custom within the advisor portal to align that account with a certain growth rate. So that is the basics here. That is where we start with this conversation. So again, we control at an advisor level the assumptions that guide the rates of return by investments. We can control the investment strategy as well over time to determine the changes that we might see. But when we're entering data, we're really talking about what is the value of these accounts today, and what are the investment strategies for these accounts as of today. We can then move to the investment tab to analyze further, what's the overall breakdown of accounts here. This particular client is in a 62-38 breakdown of equity fixed income. We can see the rate of return associated, but we can also see, the actual rates of return, associated with the other investments as well, as we look at individual accounts versus the whole picture. So let's talk a little bit about the next steps here. We know that the current plan has a specific investment strategy. So as I visit the settings here within this client plan, we can see that this client's investment asset allocation method has been changed from using the same investment strategy forever to using a pre and post retirement investment strategy. And what we want to say is pre-retirement, they're using the information that was entered within the advisor portal. And then post-retirement, maybe I'd like to see this client get more conservative, for example. And so I can actually see that in action in two separate places. So this is now built into the financial plan, and this is going to say that the investment strategy pre-retirement uses what's listed in the net worth. Post-retirement, I'm changing over to a more conservative investment strategy. And as I visit the investment tab, the first place I'm going to see this shift is in the allocation path. So here under the investment allocation path, I can see the current plan's strategy by staying exactly where we are today, and then at retirement doing a quick shift over to a different asset allocation. Now we can adjust this here. We can simulate different outcomes, but the other conversation that's important to have here is what if we want to actually do a slow migration of investments over time and not just have a single shift at retirement. And that is where our secondary setting of enabling a glide path is going to come into play. So when I talk about using a glide path, I just want to remind you all that in the settings tab, you're going to have the option to not only choose pre and post retirement investment strategies, but also you can enable a glide path. And we can customize the glide paths to have different investment strategies. Maybe you have one that retires with a moderate portfolio or a balanced portfolio, or maybe you're just using the default glide path. We're going to talk more about customization in a minute. But the glide path transitions the client from where we are today into, let's say, a different investment strategy slowly over time. And the grading is an important part of this because we want to know how long is it going to take for the client's current investments to become out of context or not used, right? So how long does it take to get from where we're 100% invested in what's listed in the net worth to being 100% invested in this glide path investment strategy? So is that going to happen in a single year? Is that going to happen slowly over 10 years? In this case, we'll do a 10-year grading, and essentially what that means, everyone, is that each year we're going to be moving 1/10 of the way towards a new investment strategy. So year 1, we'll see the client 9/10 invested in their own investment strategy, 1/10 invested in the glide path. But by year 10, we're going to be 10/10 invested into the glide path and not at all invested in the current strategy listed in the profile net worth. So again, what's currently listed here is important. And in the investment strategy area, you can see what that current investment strategy looks like. But we know that maybe we do want to transition this over time. And that's where the glide path can help us. So this glide path is actually going to say maybe even at this point we're getting more aggressive and then tapering off into a more conservative investment strategy over time. So this again is built into RightCapital in the current plan, and I mentioned there's 2 places to see this. This allocation path is the first area where you can see this impacting the financial plan, and the actual retirement cash flow analyses are the other area where we can see this. And the cash flow analyses will allow us to actually see the rates of return shifting over time based on the investment strategy. So at this point, let's look at this client's current plan, and we can see in the retirement cash flows what their net worth looks like, but we can also see the invested assets and how they grow. So based on the beginning balance, we can see a shifting portfolio return that's going to align with that glide path over time. So again, we see the actual returns growing, getting more aggressive, and then eventually as we get into retirement, we start to see those ticking back down as we make our way through that glide path transition and we start to deplete assets. So all of this is a conversation about the current plan, right? So again, the shifting from pre and post retirement allocation can affect the current plan. Shifting assets over time with a glide path can affect the current plan. But I know that many of you are actually saying, we want to recommend a different investment strategy, and we want to be able to show the value of that. And so for that conversation, we're almost there, I promise. I just want to quickly, bring us to a different plan here so we can see this in a different area. But I also just want to mention that for any of you who've seen me, looking at different model portfolios with different rates of return, or maybe those of you who've seen me, look at custom glide paths, I just want to remind you that all of that information is available to you in your advisor portal, no matter what subscription you have with us, basic, platinum, premium. And under this models tab is where you're going to find all that data. So for example, we have the default model portfolios from preservation to most aggressive here, outlined with the annual returns that are associated with the breakdown of investments. But I also want to note that if you wanted to build out your own, hypothetical portfolios, you're welcome to. You can build a rough 6% return portfolio just by adding a new portfolio, listing the different breakdowns you'd want to see, and coming in at a rate of return that's appropriate for you. You can also base these portfolios on holdings as well. That's a recent update that we've had. So you're able to actually create holdings-based portfolios. And once they're built out a single time here, these can be plugged in within every client's financial plan, and they can actually, even be set at a global level at the advisor assumptions. So you maybe want, a risk-wise integrated model that's, going to reflect your, let's say, retirement allocation. You can do that. Now, let's now just quickly mention the glide path, and then I promise we'll get into the fun proposal aspect of this. So everyone, the glide path is going to default to showing the client basically on a path towards retirement, right? So we count down the years to retirement. And so we think about this as kind of a generic feature. As it's applied to a specific client plan, we're just going to analyze how far they are away from retirement and what their investment strategy should be. So here we can see as we tick down years to retirement, the default glide path is going to meet retirement with an investment strategy at a 50, 40, 10 breakdown of equity, fixed income, and cash. So again, the grading period just tells us, simply how long does it take, to get from today, where we're 100% invested in our own investment strategy, to where we're, again, 100% invested in this glide path strategy. A quick example is if we have a 1-year grading period and I'm currently in a 90-10 asset allocation and I'm 1 year from retirement, I'd say that this year I have a 90-10 investment strategy, but next year I'd actually have a 50-40-10 based on the glide path, because my grading was only 1 year and it would immediately shift after that year. While if I had a 10-year grading, it would take 10 years to slowly change from where I am today to be fully invested in this glide path. So, but again, default glide paths, you can, customize your own to, again, retire with different, portfolio balances. But once you build these a single time, they will be available in every client plan. So it's worth a little bit of the effort up front. Perfect. So thanks for bearing with me through that. There's a couple really good questions here, but I'll jump back to them in just a minute, I promise. Just want to make sure we're getting through the content for all of you. So the next piece here is proposing a different investment strategy, everyone. So let's, for example, take a look at, Chandler. So Chandler is going to be our case study here for just a different, proposed investment strategy. And I want to let you all know that we talk a lot about the current plan that stems from the initial data entry, but the retirement tab in RightCapital is really where we talk about what are the recommendations we're making and how can we simulate different investment strategies. So for example, maybe we are looking to create a situation where Chandler here has a different investment strategy within a proposed plan. So let's walk through this together. Maybe we'd like to see Chandler invested in a aggressive investment strategy today in a moderate asset allocation at retirement. I can first get organized here within the retirement analysis by building a new plan. Let's just call this plan, reinvestment strategy. I did that by clicking the pen and paper icon to the left of the actual current plan. And after doing that, I was able to create that new plan. And what we then see is here under, this area, we then have the option to create a new proposal based on all new data at the bottom of the screen. This data at the bottom of the screen only impacts the proposed plan on the left that we're creating. So let's just, quickly kind of walk through this. So the first thing I want to do is, make sure that Chandler's invested in a growth allocation today and a retirement asset allocation later on. I should say in a retirement asset allocation of a more moderate investment strategy. But I only see one area here, the asset allocation. I don't see as many options as maybe as I want. I can see a glide path, but I don't see maybe a pre and post-retirement investment strategy. And I just want to remind all of you that what strategies are listed here will be based upon the actual settings that we're using. So because we're using a glide path in this plan that slowly transitions the data over time, we only see the glide path option and the ability to change the starting place of that glide path. Now, because I want to change this, I'm going to go to the settings. I'm going to visit that same asset allocation setting that we've been talking a lot about today. And I'll be able to say, here's my current strategy, here's my proposed strategy, or I'm sorry, my pre-retirement, post-retirement strategy that's selected. I can head back to the retirement tab, for example, then, and we're going to see the investment proposals change to where in that proposed plan, I now can offer options for the pre-retirement asset allocation and the post-retirement asset allocation. So again, maybe I want to be in a growth or aggressive model pre-retirement. I want to be in more of a balanced or a moderate asset allocation post-retirement. And by simply adjusting these there, I can then look and see what is the changes we have in this proposal on the left. Now, obviously, when you get more aggressive, you might see a decrease in the probability of success, as well as an increase in ending assets. That can happen. But in many cases, you're going to be able to say, well, here's my new reinvestment strategy that leverages, this different, tiered strategy, pre-retirement, post-retirement, as opposed to just what you're currently invested in. And I can say that here is the value that this provides to your financial plan. And it's as simple as that. So we can choose not only, pre-retirement, post-retirement investment strategies, but also, by adjusting the settings, we can toggle on and off glide paths and talk through exactly what that means for the client, right? So maybe we know we're in a 70-30, but we want to be in more of a, let's say 80-20 aggressive model. So here's again what we're changing in the investment tab. We're moving from the current investment strategy to the aggressive investment strategy. And this would actually tell us within the investment tab what steps are necessary to take our current investment strategy to the targeted allocation. Again, walking your client through what steps to take, reducing equities, in this area, decreasing cash, increasing international equities, increasing international bonds, emerging markets, and that would bring us from our current targeted current allocation to the target. And again, we talk about what would need to be done to make this happen under the investment tab, and we would talk about the impact of that on the financial plan within the retirement tab, where we can say here is the value this provides to the financial plan. So again, there's a fair amount of areas that you can look at these transitions, but generally speaking, we provide you the visual backdrops to what we're doing within this investment area, where we can see the current asset strategy, maybe the the planned investment strategy over time that we're looking to transition to, versus the actual retirement tab, which is where the rubber hits the road. This is where we run our 1,000 Monte Carlo trials. This is where we look at all the different scenarios and the range of potential outcomes. And as well, we can compare these investment strategies not only within a linear growth assumption, but also we can talk through, well, what if there's a bad decade followed by slow growth, or a Fed adverse scenario followed by modest growth? How are these different investment strategies going to perform when we see not only growth markets but down markets? So all of this is here for you to be able to play with and adjust, but I'm here now to answer all these questions. You guys are all here asking great ones, so certainly keep them coming. We'll stick around. We'll make sure we answer all these, but I do want to mention, if you are ever looking for more information on this, the Help Center in RightCapital is a great place to visit. We'll not only host this webinar that we just are recording as we speak under our previously recorded webinars area, where you can access every webinar we've ever done here, but you can also, of course, just simply type in keywords like glide path or asset allocation, and you're going to be able to find video overviews, FAQs, data entry articles focusing on all these data points that we've been covering today. Wonderful. So let's dive into some questions, everyone. Let me just grab this here. So great one from George. Does the grading period always start immediately, or can you delay the first day? Well, that's a really great question. The answer is actually based on your settings, George. So just note that the gear icon settings in RightCapital allow you to change when the cash flow simulation actually begins. Is it next year? Is it this year? Is it just 12 months from today? So typically, the glide path would occur or begin adjusting 12 months from today. That's generally how it works. But if you like to, see that, maybe immediately projecting, you can adjust to the current month setting. But typically we'd see, if it's a 1-year grading, it would take 1 full year for that to kick in. Great. In the assumptions asset returns, so heading to my settings here, going to return assumptions. Let's see, the asset returns are entered for year over year. Realistically, however, the returns are dependent on the time horizon. Yep. Is there a way to model different time horizon in investing? Secondly, how are your deviations used? Are they used in the Monte Carlo analysis? Absolutely. So yes, the standard deviations are used in the Monte Carlo simulation. There's some advanced parameters too, where you can actually adjust correlation matrix as well if you are a platinum subscriber. But just note that, we are able to change the investment strategies based on the model portfolios over time. But obviously, if you're using forward-looking assumptions, those are not going out 40, 50 years usually. But we are here to, allow you to plug in different models that you build. So maybe you're more comfortable using just general model portfolios to, align the timelines better for your investment strategies, but you'd have to use those or the glide path to do so. So definitely, definitely worth mentioning. Great. So so this is a good question. By going more conservative, he actually had more ending asset value, right? And it depends on the plan, Michelle. So I just want to remind you that, RightCapital's Monte Carlo simulation is going to, provide us with the most, let's say, testing on that investment strategy, because we run 1,000 trials of investment scenarios on that. But I want to remind you all that, this is great. It tells us, the probability of success, the ending assets. If we go more aggressive, there will be times potentially where probability goes down, ending assets could go up potentially. But as soon as we switch over to the comparisons tab, this does look at a linear growth assumption as a default. So we can think of this as one of those 1,000 Monte Carlo trials that just earned, again, same investment strategies, same investment returns each year. But you can customize the return scenarios to say, what if, right? What if there's a bad decade? What if 2008 happens again? So that's something to be aware of. But it will be all based on, the volatility. It'll be based on standard deviation, the rate of return, and the models you're using. Perfect. This is a great question. Where did you go to select the JP Morgan projected future performance? I didn't see that in your drop-down list. So we both provide the JP Morgan assumptions in the help center, but you are going to have to be able to go into the settings for each financial plan or at a global level and change the assumptions individually. So at the advisor level, if you want to use JP Morgan assumptions, you can set that up for all your plans under the advisor portal. Or for an individual client here, let's say I wanted to go ahead and change, the global assumptions that were here to a more customized, base assumption. And this is where, again, I could drop in, an adjusted cap gain, for example, to equal, what we see more for the JP Morgan forward-looking projections. But what we want to just remind you of is you're in control of these assumptions. We use historical averages as a default. We update them annually, but it is going to be up to you to basically align your unique advising philosophy to the system so that you can be confident in the outcomes. Perfect. So quick question. I'm assuming that the Monte Carlo is built using the assumptions that returns follow a random walk, correct? That is correct. If I set a client's returns to custom future returns, is it okay to change those returns on an annual basis as market dynamics might impact the future? It is absolutely okay, but you need to know that your plans will shift. So you will see a change in the probability of success. You will see a change in the outcomes, and again, as long as you're aware of that and the clients are aware of that, you want to just make sure that's something you're comfortable with. We do think that it is appropriate to adjust returns annually. We think it's appropriate to adjust returns based on future or what predictions might look like if that's what you want to do. But again, just note that any changes you make will have impacts on the plan itself. Perfect. Perfect. Yeah. So, there's another question here we can dive into. Certainly, we do want to make sure you're aware. Obviously, forward-looking assumptions are not, necessarily projecting out as far as we are projecting in financial plans, right? So, when we're talking about our financial plan, we're talking about, 30, 40, 50 years out. And so again, that kind of goes back to our conversation around, if you'd like to use JP Morgan assumptions that are looking at a few years, welcome to do that. If you'd like to use historical assumptions, you're welcome to do that. You're also welcome to, adjust everything, based on your unique philosophy and what you'd expect. So you do steer the ship, but ultimately you can see how everything is performing both in this investment tab, under asset allocation, under allocation path, as well as under the retirement cash flows over time within that invested assets tab where you see the return being adjusted. And again, if you want to even drop in single different scenarios where things don't do so hot, you can adjust those as well within the retirement cash flows to simulate non-linear growth assumptions. Great. Great question here around, whether the CMAs are nominal. That's a great question, Chris. I believe they are. I can circle back with you if I need to correct that at all, but that should be what you're seeing there. And again, for the Monte Carlo analysis, we're going to be, including all this data, running it all through, and there's some great information there too on the stochastic model we're using and kind of the way everything is built out. All that is within, again, the actual help center here under the Monte Carlo analysis. Last thing I'll just quickly plug here as well is that RightCapital also is going to give you the option, if you want, to customize investment parameters, meaning if you are a platinum subscriber or want to be a platinum subscriber with us, we will allow you to create custom asset classes like we see here with some of these. We will see the option to update things like the correlation matrix, as well as update volatility as well. So that is a feature that's available. It's controlled at kind of a firm level. So you kind of, if you're part of a team, you have kind of a point person that would, create those and adjust those. But we are here to help. If you have questions, there's great resources from the support team to the sales team to the help center to make sure you have all the data you need to be successful. Great. Great question, Brad, about can we save JP Morgan's projected future performance as a separate dropdown? Love the idea, happily to pass it along. We can't do it yet. You can assign those globally or individually, but I'm happy to pass along the feedback for that option. Perfect. So okay, this is a good question here too. What is the glide path amounts for stocks and bonds based on? Any research? So I do believe that the glide path, the default glide path, is based in kind of standard market testing from some of the companies. I can find the research if we're looking for it. I do believe though that the typical kind of transition to 50-40-10 is relatively standard within the industry, but ultimately there is a fair amount of obviously finesse that we can do here. And I also want to remind you all that when we say 90% equity, for example, we're going to align the equity with what is already built into the financial plan. So if you're a split between large growth, large value, in the plan, when we talk about 90% equity, it will essentially align with what's already there as we transition out to the future. and just keep equity, fixed income, cash kind of all just slowly transitioning towards either a less aggressive stance, or even maybe if you wanted getting more aggressive moving forward. But again, happy to follow up with some research there, Michelle, if needed. So wonderful. We're here to answer questions, everyone. So please feel free to if you want more information on areas, if you need a clarification on anything, I'm happy to help. Again, we really appreciate you all spending time with us on these webinars. We hope you find them useful. And I know, RightCapital it's very, very streamlined system, but knowing where to look for what you need to show can be very impactful for the client presentations. So perfect. We did have a couple more really good ones here at the end. So where can I find the latest historical rates of returns? Great question. So again, RightCapital allows you to visit the help icon on the upper right corner of the screen. You can simply type in asset allocation or assumptions, whatever you want to do. But here you'll just see asset return assumptions, and this is 2022 data here. So we see the latest historical returns, the indices that we pulled those from, as well as the latest JP Morgan report data here. So, that's just something to consider. Again, we're looking back, 50 years for equities, 20 years or so for bonds. You can see the indices we use as proxies, and that should give you a good idea of historical averages, right? We know that, there's options you have, but certainly worth taking a look at. Another great question here is, what asset allocations are equity and fixed income returns for the glide path? Does it assume equity mix of domestic and international or something different? Yeah, so that's what I was in reference to. The equity mix is going to be based on the client's current investments. So if the client is currently invested in a certain strategy, we're going to keep that mix the same. We're just going to, again, kind of transition, to additional more conservative strategies later on. So we're going to kind of keep everything status quo and then migrate it in different direction as we project into the future. Perfect. Wonderful. Great. Yeah, great update suggestion for update historical returns. That makes perfect sense. I believe that's really great. So happy to pass that along, as hopefully all of you know we love feedback here at RightCapital. So we certainly don't hesitate to take it and implement it. So we'll certainly make sure that gets to the team. But all right, everyone, I think that's about it for today. We again genuinely appreciate you being here with us. We always appreciate the great questions and the interactions. If you need us in the future before next Friday's webinar, feel free to reach out to the support team. They are here to help. You can see they're going to be available not only through live chat on the bottom right, but you can call them, you can email them, you schedule a 30-minute case review. We want you all to be confident in the tool, so make sure if you need anything else, let us know. But I hope you have a great weekend. We'll see you next Friday.